Chapter 8. First of all, in Chapter 7, we dealt with selling long-lived assets, and we learned how to calculate gains and losses of the sale of those assets, and we also talked about some situations where you might not have to recognize the gains or losses on your tax return. You know, there could be deferral situations, aka like-kind exchanges, things like that. In this chapter, we primarily address the character of those gains and losses. So when you sell assets, you compute the gain or loss, like we talked about last chapter, but then you've got to decide whether or not your loss or your gain is ordinary or is it capital in nature, because depending on the character of the gain or loss, you have different treatments on the tax return. There's certain characteristics that apply to both, and so it becomes important to realize the character. The first step in understanding the character is to understand the different types of assets that exist. In this first learning objective, we talk about distinguishing between capital assets and ordinary assets. So read through this. Primarily capital assets are investments. You think of stocks or bonds, things like that. Typically not things that are used in a business. Ordinary assets are, you can kind of think of those as current assets used in a business, like supplies or accounts receivable, inventory, things like that. So if you get the idea of what different kinds of assets are out there, it's going to help you understand the treatment that'll be applied to the sale of those assets. The third kind of asset, which is discussed a little bit later in this chapter, is going to be called Section 1231 assets, and essentially those are long-lived business assets, depreciable assets, basically, that are held in a business, used in a business for greater than a year. And we'll look at what happens when we dispose of those kinds of assets a little bit later on. So this book goes to discuss the kinds of assets that are and are not capital assets. Talks about each one. You can just kind of skim through these pages, mostly just reading. Learning Objective 2 talks a lot about specific assets, the sale or exchange of specific assets, and I'm not going to take a lot out of this learning objective as far as what I'm going to hold you accountable for. So again, just kind of breeze through this section. I am going to go all the way on to study Objective 3. Or sorry, Learning Objective 3. Learning Objective 3 talks about the holding period for capital assets. Holding period is it's basically how long you, the taxpayer, are credited with holding an asset. There's a lot of there's treatment differences on the sale, on the gain loss of a sale of an asset, depending on whether or not you've held the asset for more than a year or not. So if you haven't, it's a short-term holding period. If you have, it's a long-term holding period. But it's not quite as simple as that, because sometimes you can be credited with the holding period of whoever you got the asset from. Read through these situations in determining the effect on holding period. And let's see, I will pick up with Learning Objective 4 in the next video.